This video will talk about whether you should be buying outside of Sydney and Melbourne. So many of you guys live in Sydney, Melbourne. Prices have boomed. You're out of the market. You can't buy in Sydney and Melbourne, but you're thinking, should I buy an investment property elsewhere? This will tell you exactly where to buy and whether you should actually do it. So my name is PK and I help people build passive income by buying properties that have a combination of positive cash flow and capital growth, without spending years on realestate.com, without spending $15,000 every time on a buyer's agent, right? And without it causing tension, right? That's the most important thing. So guys, if you like my content, if you enjoy this video, smash the subscribe button. Once you have done that, turn the notification bell on so you see every video. Please hit the thumbs up icon, give it a like, give it a love, tag anyone who's actually in this boat that you know about, wanting to buy outside in Sydney, Melbourne, but not sure if that is the right move from them. So regional versus capital cities is to some extent the topic of this video, but really it's about dispelling the myth that you need to only buy in Sydney and Melbourne. So many of you think that, oh, look, I really do want to buy somewhere else, but it's huge risk. You know, Sydney and Melbourne are the biggest metropolitan cities in Australia. Jobs are always going to be the most there. Immigration is always going to be the most there. Do I really want to put my hard-earned money in places other than Sydney, Melbourne? Is that really a good use of my investment dollar? So let's go through some statistics. So let's rewind back up, right? I'm just looking at my notes here. So let's look at median capital city house prices. And I'm going to go through the house prices from 1990 to 2019, all right, and give you the average growth. So Sydney in 1990, the average median house price was $194,000, and in 2019 was $808,000. The growth on average per year was 5%. Melbourne, $131,000 in 1990. In 2019, so 20 years later, was $645,000. That's 5.7% average growth. Brisbane, 113 to 493, 5.2% growth. Adelaide, 97 to 434,000 from 1990 to 2019. 5.3% average growth. Perth, 100,000 to 446,000, average growth of 5.3%. Hobart, 82 to 457, average growth of 6.1. Darwin, 101 to 416, average growth of 5%. Canberra, 120K to 600K, average growth of 5.7%. What you're noticing here is all of these are capital cities. All of the growth, the average growth, has been between 5 and basically 6%. In fact, Hobart has been the best performer, 6.1% average growth over the last 20 years. The worst performer, I'm scanning down, the worst performer, get this, don't fall off your seats, is Sydney. Right, so for all of you guys who have immigrated into Sydney, or you live in Sydney and you're like, this is the biggest city in Australia, this is where I should be investing in properties, this is the one that's going to do the best over the long term, you know, I can't make a mistake. Well, I mean, the reality is that it has been the worst performing city out of all capital cities in Australia over the last 20 years. Where is this data coming from? I'm not making this up. This is the Australian Bureau of Statistics. And sorry, I just want to correct, it's not 20 years of data, it's 30 years of data. 1990 to 2019 is 30 years basically. So 30 years of data tells us that there's actually a negligible difference between the capital cities, and B, that the ones that you thought were performed the best are the ones that have actually performed the worst, right? So I just want you to connect with that point. I know you kind of have to start to unlearn some things when you watch my videos because it's all just based on data. I always say, don't listen to me, I'm just another expert. The data is what's important. So if you're only thinking of buying in Sydney and Melbourne because that's your cognitive bias, that's what your friends are telling you, that's what the media is telling, that's what your family is telling, that's where you think the jobs are created, that's where you think the immigration happens. Well, all of that may or may not be right. I don't really care. The data says otherwise. You should not just look at Sydney and Melbourne, all right? And look, most of our media, most of the noise that you hear in property circles is originating from people in Sydney and Melbourne. So, you know, there's a fellow called Michael Yardney, great guy, very experienced, and there's so many people like that. Google him; he's a good guy. But you'll see that all they talk about is buying in Sydney and Melbourne or capital cities as close to the CBD as possible. Those are all just myths, and the data completely proves them wrong. So what I want to do now, with your permission, is I want to go through not just the last 30 years of data, but the last 5 years of data. So this is between 2015 to 20. All right, so it's a little bit old, you could say, but it gives you 5 years of data. And let's see the capital growth across different cities. Because you might say, PK, what you've just quoted was 30 years of data. Who knows what's going to happen in the last 30 years? This is what's happened in the last 5 years, and so it's giving you more relevance. So I'm going to go around the country, and I'm going to give you some hotspots. I'm going to give you some locations that you may want to invest in as well. But I'm trying to illustrate the point that it's not just Sydney and Melbourne that grow. So let's go. In the last 5 years, so let's say 2015-16 onwards, Mildura has grown by 25%, and this is Victoria. In Victoria, Mildura 25%, Shepparton 25%, Bendigo 21%, Ballarat 41%. 41%, 5 years, guys. Melbourne 37%, so good growth, but dwarfed by Mildura. Geelong 44%. So already out of the ones that I've mentioned, half of the locations have beaten Melbourne in Victoria. And Warrnambool 22%. All right, so hope you're getting the idea that it's not just Sydney and Melbourne that actually grow. Like, I've done so many videos on principles, guys. Here I'm just going into the data. Now let's look at Hobart and Tasmania. Burnie has grown by 26% in the last 5 years. Launceston by 32%, like 32%, and it continues to grow. Right, Hobart 55%. I remember when we were investing in Hobart around 2015, 2016, and even I had to convince my clients. I was sort of saying to them, look, the data looks really good, and they're like, PK, like, are you really telling us to invest in New Zealand? I was like, Hobart is not New Zealand. I know it's not on the mainland, but the data looks really good, and here's why. You don't need to be, an expert. You just need to follow an algorithmic system. And those who listened have doubled their money, because what I'm sharing you are the median values. Of course, you can beat the median and underperform the median as well. All those clients have doubled their money. Let's go now into regional New South Wales. So Byron Bay, last 5 years, 50%, give or take 50%. Ballina, 38%. Coffs Harbour, 43%. Port Macquarie 35%, Newcastle 33%. Sydney is the worst performing out of all these New South Wales cities or towns. Sydney's the worst performing at 25%, Orange 36%, Griffith 41%, like Wagga Wagga a little bit less, 18%. Like, hopefully this is making sense to you. This isn't me just bringing out some statistics out of thin air trying to prove a point that doesn't matter. The point that I'm trying to hit home is that both in the long term and in the recent short term, these capital cities have underperformed. Now, I'm not trying to get you to invest in regional areas, but I'm just trying to lift the lid, look up and out, beyond your myopic thinking to really understand what is possible. Because what is possible in these areas outside of Sydney, Melbourne is positive cash flow, which you can't get in Sydney, Melbourne. Plus, they're outperforming their Sydney, Melbourne suburb counterparts in terms of capital growth. Like, what else do I need to say? Anyway, let's carry on, right? Let's look at now. Let's kind of look at Queensland, which hasn't performed that well. So it's not a case that PK said you should invest in regional areas. So let's put our blinkers on and just invest anywhere regional. Let me give you some bad examples. Cairns, 6.1%. Townsville, negative 8.6%. Mount Isa, negative 40%. Gladstone, negative 20%. Now, guys, these are some bad stories. There's also some good stories in Queensland. Sunshine Coast, 25%. Gold Coast, above 20%. Brisbane, 15%. Right? So, in Queensland, you have areas that have performed worse than Brisbane and areas that have performed better than Brisbane. So what's the whole point of me saying this? The whole point of me saying this is that A, you can outperform Sydney and Melbourne in terms of growth. B, that outperformance can not just last 1 or 2 years as a bit of a blip, but over the short and super long term as well. C, the positive cash flow story that you can't get in Sydney, Melbourne is available in these other areas. So don't, discount them. And lastly, D, or number 4, is that you can't just go out and do this willy-nilly. Not all areas in regional will perform. So you need to follow the data system, very specifically and very accurately. What I teach my clients is not a magic algorithm that just works, regardless of who you are, but it's algorithmic, right? It's not a magic system that you put your first and last name in and your date of birth and it spits out an answer, but it's systematic, right? And you don't need to be on the ground 60 hours a week to really do this stuff. Everything's based on the data, and you can do that in 3 or 4 hours. But let's come back to the data points, right? Now, I know what you're thinking. You're saying, PK, you talked about positive cash flow slightly, you talked about growth, but what about vacancy, regional areas? Who even lives there? Like, what even jobs are created there? How do we know that the place isn't going to be empty? Sure, our money can double in 10 years, but what if we don't have tenants for 2 of those years, or 1 of those years, or 3 of those years, or 5 weeks every year? Let's dispel that myth, not based on my opinion, but based on data right now. Okay, so let's get into it. I'm going to talk to you now about vacancy rates. All right, let's do that right now. So vacancy rates, and I'm picking the absolute worst time to be quoting this stuff, because I know what you sometimes think. You think that, a lot of these property commentators, they pick and choose data points that suit their story, that suit their agenda. You can manipulate data to show anything, really. A statistician is often called a journalist because he can pick and choose data points to craft a story that the unsuspecting viewer or reader doesn't really understand, therefore just accepts. Now, I'm not trying to do that. I'm giving you the worst month in which to quote vacancy rates, and that was in the middle of the pandemic in 2020. June 2020, we're smack bang in the middle of COVID-19. June 2020, across Australia, worst time in property, apparently. Let's go around and quote some vacancy rates. And remember, when you hear a vacancy rate that's less than 2%, that means that demand is actually stronger than supply in the tenant market. That means it's really easy to get a tenant. That means rents are rising. That means that the vacancy is going to be less than a year on average. So let's just go around the grounds and compare Sydney, Melbourne, Brisbane, the ones that you naturally lean towards because they're safe, to other areas. All right, so let's start with some mining towns. Port Hedland and WA, vacancy rate 0.9%. Karratha, 0.5%. Perth, 1.5%. Esperance, that's regional WA, 0.7%. Albany, 0.8%. Bunbury, 1.8%. Busselton, 0.5%. And Margaret River, 0.4%. So what you just saw there was that the vacancy rate is tightest. In other words, the tenant market is the tightest outside of Perth in WA. So regionals are outperforming the capital city. Now you're like, oh, well, maybe that's just a Perth thing. I don't really understand why that's happening. Maybe it's because of the iron ore prices booming, all that kind of thing. Well, let's come down to, where should we go next? Victoria, all right. Shepparton, 1.2%. So remember, this is a point in time, June 2020, middle of the pandemic. Shepparton, 1.2%. Bendigo, what is that? I'm looking at my notes. 1.7%. Ballarat, 1.7%. Warrnambool, 0.7%. Geelong, huge, 3.5%. Melbourne, 3%. So except for Geelong, Melbourne had the worst vacancy rate anywhere in Victoria. All these regional areas, you were making money in capital growth, you were making money in terms of rent rises, and you were making money in terms of having no vacancy. All right, let's look at South Australia. So Whyalla, 0.6%, June 2020, remember? Adelaide, 1%, Port Lincoln, 1.7%, Port Augusta, 2.2%. So apart from Port Augusta, all these areas in South Australia, you wouldn't be having any difficulty finding a tenant, much to the, which is a lot different to what a lot of you guys think. You think if I'm buying outside of Sydney, Melbourne, how am I going to find tenants? Here's the data. Here's the real vacancy rates. Anything less than 2 is good. Anything less than 1.5 is great. Anything less than 1 is super excellent. Let's look at regional New South Wales. Armidale, not that great, 2.8%. So once again, you can't just, blindly invest in any area. Tamworth, once again, 2.3%. So no, it's not super good. Dubbo, 1%. Orange, 1.7%. Griffith, 0.5%. Mildura in regional New South Wales, fantastic place to be buying, 0.6%. All right. So once again, if you compared this with Sydney, 3.8%. These areas are killing Sydney. Let's look at other regional New South Wales. Byron Bay, 2.6%. Ballina, 1.5%. That's great. Coffs Harbour, beautiful place to be investing, 0.9%. Port Macquarie, 1%. Newcastle, 1.9%. Wollongong, 1.4%. Wagga Wagga, 1.3%. So guys, once again, Sydney has basically underperformed most regional areas. And we know that in these regional areas, like I just went through, you would have made way more money in the last 5 years than the capital cities, and the tenant attrition was lower, the rent rises, the passive income increases every year were higher. So hopefully this picture is coming together really, really easily, and hopefully you're not getting overwhelmed by the data. This video is all about data. Tassie, Burnie, 0.4%. All right, I have properties in Burnie. I mean, they've all basically close to doubled in 5 years and never had a single day of vacancy. Rents have gone up 67, 70%. Launceston, 1.9%. Hobart, 0.8%. The numbers speak for themselves. Anything less than 2% is great. The point being, regional is not bad. I'm just trying to, sort of ram this home, just kind of pushing down so much data. Now, Queensland's not perhaps as good in terms of capital growth over the last 5 years, but let's look at the vacancy rates. So Cairns, 2%, Townsville, 0.6%, Mackay, 0.8%, Rockhampton, 0.6%, Gladstone, 1.6%. Remember, this is June 2020 data. Hervey Bay, 1.3%, Bundaberg, 0.5%, Sunny Coast, 1.2%, Brisbane, the highest, okay, the highest meaning the worst, 2.4%, Gold Coast, pretty high, 4%. Mount Isa, 0.4%, Toowoomba, 0.7%. So the idea of demonstrating this is that I've said that capital growth has been superior in these regional areas, in many regional areas, than cities, capital cities, over the last 5 years. Over the last 30 years, whether you invested in any capital city or any regional area, the growth has been very similar. In fact, Sydney's the worst at 5%. And the ability to get a tenant is no worse in regionals than it is in capital cities. In fact, regionals are better than capital cities. So I'm trying to paint for you the picture. Of course, there's more than 30, 35 data factors that you need to be considering when selecting where and what you should be buying. But hopefully this is painting for you the picture that regionals are not bad. Like, I grew up in New Zealand, and, everyone says Auckland has, just performed so well, and Auckland is tripled in value over the last 10, 15 years. But I can tell you that in New Zealand we didn't really have this view of regionals versus capital cities, because even the smallest towns like Napier, where I grew up, has performed just as well as Auckland, right? So this regional versus capital city debate or argument is really an Australian product. I don't really know where it comes from, because the data doesn't really say that regional is any inferior, whether in terms of economic outlook, vacancy, capital growth, or anything like that. Of course, you need to do your due diligence, but that's that. And before at the risk of boring you guys, if you're still with me, I'm just going to hammer home more data. So you're probably thinking, okay, well, you quoted vacancy rates at a moment in time. Sure, PK, that was in the middle of the pandemic, but what about rent rises? What if rents didn't rise in regional areas? Well, let's look at rent rises then, shall we? I've got the notes in front of me for this video. So I'll mention the capital cities first. So Sydney, rents rose, let's say in 2019-20, by 0%. Compare that to Newcastle, 2.3%, Coffs Harbour, 3.4%, Byron Bay, 3%, Armidale, I'm talking about regional New South Wales here, 5.9%, Orange, 2.7%. So once again, Sydney has underperformed in terms of rent growth, not just vacancy, not just capital growth, but rent growth. That's that passive income, that positive cash flow going higher and higher and higher and higher. Let's look at Tasmania. Burnie, 3.7%, Launceston, 6.3%, Hobart, 7%. So just in 1 or 2 years, rents are rising, which is exactly what we want to see. Does this also happen in regional Victoria? Mildura, 5%, Shepparton, 3% rent growth, right? Annual per annum rent growth over 2019-20. Bendigo, 6%, Ballarat, 10%, Warrnambool, 8%, Geelong, 6%, Melbourne, 1%. So not just in terms of capital growth, not just in terms of vacancy, but also in terms of rents rising, that passive income increasing, regional is outperforming. Whew, this is fun. Let's look at Queensland. Cairns, 3.6%, Townsville, 6%, Mackay, 8%, Rocky, 3%, Gladstone, 12%, Hervey Bay, 4%. These are big numbers, guys. Brisbane, 1.2%. Okay, same phenomenon. Regionals outperforming capital city in Queensland. So look, I'm just going to probably just leave it there because you guys are probably going to get bored of me just shoving data down your throat again and again and again and again. But the last analogy that I want to leave you with, and I'll stop looking at my notes, the last analogy that I'll leave you with is capital cities and regional towns in Australia are like two tennis balls. Think of one tennis ball as capital cities and the second tennis ball as regional towns or regional centres, whether they're big ones like Newcastle or Geelong or smaller ones like Bendigo or Ballarat. Now, think of these two tennis balls as connected to each other on a string. When you take one tennis ball and you throw it up, then naturally the other tennis ball follows. Maybe it's a bit delayed, but it follows, right? And then when the first one, because of gravity, starts coming down, the second ball, because it's connected by a string, also starts coming down. That is how regionals and capital cities work. Capital cities will rise in value, and then because of the affordability story, people start going to regionals, and then regionals start growing in value. And then capital cities start coming down, and regionals still might be going up, but at some point they start plateauing or flatlining. They may or may not come down. So over the long term, the two tennis balls, because they're connected to a string, they perform very similar levels in terms of capital growth, right? So anyone who says investing in regional is more risky, just blindly more risky, that is not true. The two tennis balls are connected. It's about timing. Which tennis ball do you want to go with? So let's say in 2010 to 2015, you should have gone with the capital city tennis ball. Now it may be better opportunity to go for the regional tennis ball in terms of capital growth. But the idea is that they will perform very similarly over the long term. We want that 50, 150K bump in capital growth in the first year, 2 years. We want to have it while buying positive cash flow properties. You can still do that in capital cities right now, but you can also do that in regional areas. So hopefully this video helped you, for those of you who are priced out of the Sydney-Melbourne market, to expand your horizons and just really by understanding data, quench your thirst for filling yourself with confidence that actually I can do this outside Sydney, Melbourne. Hopefully that was valuable, guys. There was a lot of data. I'm pretty tired. If this gave you value, hit the subscribe button, turn the notification bell on YouTube, hit the thumbs up. So this video goes to more and more people on Facebook. If you're not part of my Facebook group, there's 7,000 people in there. Join. If you're not part of my YouTube community, join. Let's get this video out there. Tag someone who might benefit, and I'll leave a link below so that you too can build passive income without using a buyer's agent by buying positive cash flow, growth properties that grow in value quickly, giving you passive income without dropping 15K every time on a buyer's agent, without catching flights around the country and spending your weekends at inspections, and most importantly, by not making a mistake. My name's PK. I hope you have a fantastic day. Catch you later.